Good day. I welcome you back to the fourth lecture on portfolio evaluation and portfolio revision, which is talking about active and passive strategy, which I have just touched upon when we were discussing Jensen's alpha, but I did not go into the detail of it because we had a separate lecture on active and passive strategies. So, in this particular lecture, I would be talking about what is meant by active investment, what are the active management strategies which is available, what do you mean by passive investing, and how passive investment works, types of passive investment which is available, and then it talks about the advantages and disadvantages of these two strategies. So, first let us look at what is active investing. So, active investing is nothing but it is an investment strategy. It is an investment strategy where you are trying to say that the fund managers or investors are taking. What are the strategies they are taking at the time of either buying or selling a share, or if suppose I want to hold the asset for a particular period of time. So, investment strategy, active investment strategy talks about the role of either fund manager or individual investor while taking a decision on whether to buy, whether to sell, or whether to hold asset in a particular market so that you get a better return, right. So, if market return is 10%, how your portfolio can give you a return of 12% is something which talks about whether to buy, sell, or hold a particular asset, and this is the strategy which an active investor takes. Okay. So, this is active investing. So, whereas passive investing says that you just try to match the market return, whereas active investors select investments which is going to give you higher yield. So, you should understand, one is passive, you are not bothered about a higher return, you are just bothered about a return which is at least the market return, which is 10 percentage. If you are getting 10 percentage, I am happy, I am not going in for any portfolio revision or anything of that sort. So, that type of investing is passive investing. So, whenever the portfolio comes below 10 percentage, I will think about a portfolio revision. Whereas, an active investing says that I am not concerned about the benchmark set as 10 percentage, I am concerned about getting something more than the benchmark which I have set. So, that type of investment strategy which gives you a higher yield is part of active investing. What are the approaches to active management? So, active managers use various techniques to achieve above market return, and above market return can be achieved only if suppose they do enough research on the different stocks in which I am going to invest. Okay. So, this is based on historical data where I would be trying to see how a particular stock is performing historically. Okay. So, past record basis I am trying to find out how it has performed. Then based upon the past performance, I am trying to forecast how it would be performing and what could be the expected return, and based on the expected return, I would be taking a decision on whether to buy or sell a particular stock. So, in the process of doing an active management, what is the three important aspects which important? One is market timing. Timing, I try to predict the market movement and time trades. So, this is normally, if suppose I am going to I think I've told you when I was talking about fundamental analysis. If suppose in technical analysis, let us assume that I have a tick by tick data in a day, which talks like this, right? And this is starting from 10 a.m. 0, this is time, x-axis is time, and this is the price. Okay, so this is at 10 a.m., this is at 11 a.m., this is at 12 noon, this is 1, 2, etc. So based on this, I can find out which is the best time. So over a period of time, I am trying to analyze, and I am finding that this is the best time when I can sell a share. Okay, and what is the lowest point in a day which it has happened over a period of time? It comes to be say 10:05. So the best time to purchase a share would be 10:05, and the best time to sell a particular share would be somewhere around 2 o'clock or 1 o'clock, wherever I find that it is coming out to be the highest. So this is based on historical data and how the market has been performing over a period of time. I can very well take a decision on the market timing, when to enter a market and when to exit a particular market. The second important decision which I can do is because of my analysis, I can identify the sector and asset selection. So in fundamental analysis, we have already talked about industry analysis. So I can identify how a particular industry is performing within a particular economy at a particular point of time. So based on this, I can identify either the specific sector, I can identify the either the industry in which I have to invest, and narrowing it down, I can find out which is the individual security which I have to bring it as part of my portfolio, right? So that is a part of active management. The third is, it is told that the investment, you can also invest in non-indexed securities. So most of the time when we are talking about portfolio construction, we are concentrating on those securities which are indexed, right? So which is part of the indexed thing. There are many other instruments which are not part of indexed securities, which in the first lecture probably Dr. Anandita Chakravarti might have discussed about it. So there are other decisions, other investment things also which would be considered by active investment, as to what are the other assets which you can hold and which is not part of the benchmark index, but it will help you to diversify and get a high return. So this is what is done in active management. So you are considering both those securities which already has an index, those securities which is not part of the index, combination of all these, you are putting it into your portfolio and you are trying to construct the best portfolio which is giving you a higher return than your expected return. How is this done? This is done based upon research and analysis. So I told you historical data. I use historical data to do an in-depth research and analysis. And in order to do this, I am using either fundamental analysis or technical analysis. I can include macroeconomic analysis as part of fundamental analysis, or else a separate thing. So here in fundamental analysis, I am talking about the company's financial health, because financial statements is available with you, and based on that I can find out what is the intrinsic value of the share, and if suppose the market value of the share is less than the intrinsic value of share, then it means to say that the value is lesser than the actual value, and there is an opportunity for those stocks to grow. So I can very well invest in such types of companies based on my fundamental analysis. The second is technical analysis. This is a graphical way of analyzing. So, you are trying to study the market patterns, and based on the market patterns, I can superimpose the predictions and find out how the price movement would be. If suppose similar patterns have been followed over a period of years, then I can superimpose the projections and I can say that this is the best period when to enter into a particular sector or particular type of industry and when to exit a particular type of industry if suppose I want to make it a part of my portfolio. Those as part of my portfolio, I can very well do it. Then the third thing which is part of fundamental analysis, but separately taken up over here is macroeconomic analysis. So, this is the first part of fundamental analysis where I do an economic analysis, and this is a broader perspective where I am trying to see how the economic environment is performing, and within this economic environment we also include interest rate, we include inflation, we include geopolitical events, we include GDP, etc., forex, all those which we have already we were talking about fundamental analysis. What are the examples of active strategies? So, one of the example of active strategy is stock picking. So, what do you mean by stock picking? Stock picking is selecting the individual stock which is expected to perform well based on the financial statements which it has presented and the growth potential it has shown and where in which particular industry it is positioned. So, it is very simple, it is a micro level study which I am trying to do. I am trying to identify the particular stock or particular share in which I want to put my money based upon the basics. The basics are the financial metrics, and then I see how it has performed over the years, the growth potential, and whether it is falling within an industry which is showing a growth prospect based on the life cycle. I think you might be remembering life cycle. So, based on that I try to identify it, I can do a stock picking. Next is sector rotation. What do you mean by sector rotation? Sector rotation is nothing but you are allocating the investments to different sectors. How? Based on whether the manager is seeing a growth potential or a lesser risk. Okay, you can have a relationship between these two. So, sector rotation is identifying which sector I have to put my money in and whether that particular sector is showing a potential for growth at the same time having a lesser risk or a higher risk. All these things are taken into consideration before I say that I am going in for a sector rotation. The third is long and short strategies. So, long and short strategy, it talks about purchasing or buying of share expected to increase in value, that is called long position, while selling short is anticipated to decline, aiming to make profit both up and down market. It is very simple. I think I have talked about it in one of the lectures where I am trying to sell shares which I expect to have to increase in value, but I am not actually holding this share, I am not holding the share. So, what does this mean? Let us, I told you the example, I do not know which company I had taken. Let us take the example of gold. Okay. Let us assume that the gold prices are likely to go up in the months to come because it is going to be wedding season and other things. So, the gold prices are likely to come. So, what I do? I enter into a contract where I say that I am ready to sell 100 ounce of gold at say 3000 per ounce, for example. Okay, but I am not actually owning this 100 ounce. What I do is I enter into another agreement. This is a selling agreement. Okay, I enter into another agreement in the same market where I purchase 100 ounce at 2,800 rupees. This is purchase, right? So, what is happening? I am selling first something at a higher price with the expectation that I would be getting it at a lower price in the market. So, this is called a short position which I am going to take, and a long strategy is the opposite, where I already have certain thing and I believe that the prices is likely to go down in future and I sell it up beforehand. So, both things can happen. So, it is buying stocks which is expected to have value getting increased in future, that is you are taking a long position, and short position where it is anticipated to decline in future. So, it depends upon purchase and sell strategy which you are talking about. Now, what do you mean by passive investing? We have already talked about active investing, active management, and active investing strategies. Okay. So, passive investment strategy, as we have just touched upon it in the earlier slide, it talks about getting something equal to the market index. So, it means to say that I am not very active in taking investment decision. I am just bothered about the portfolio, whatever I am holding, it should be at least giving me a return based upon the market index which is prevailing. So, if it is going to give me that particular return, I am happy about it. I am not going to think about any portfolio revision or anything of that sort. So, this is a passive way of investment, and here I am not concerned about making money a lot, right. I am just bothered about saying that my investment is safe or moving in line with the market. That is all what I am thinking about, right. And it is just mirroring the market return and talking about minimal purchase and selling of individual shares. So, the primary objective is to achieve a consistent long term growth. So, which means these are individuals. So, you can have two category of individuals performing in the stock market. One I told you, it is traders, and the other one is investors. Okay. So, this category of persons are part of investors who are not concerned about daily purchase or sell or making profit out of the stock in a day and then shifting to another things. So, then they are not concerned about it. In the long run, they keep the stocks with them and they are very consistent with their idea that at least whatever they are going to get would be at least equal to the market return, or it would be over and above the market return. That is it. Okay. How is it working? It is nothing but an index replication, I told you. So, index is mirror image of the performance of market. So, performance of market. So, I am going to hold the same security in the same proportion till it is at par with the target market index. Okay. And if there is any change, only then I would be thinking about the alignment, changes in the portfolio alignment. Okay. Second is low turnover. Low turnover, as the name suggests, I am not indulging in buying and selling, frequent buying and selling. So, I am very passive in my way of looking at things, and I do minimum buying and selling, and this actually is resulting in a lower turnover and fewer transaction cost, because I will be saving on transaction cost also. This strategy is having a approach of buy and hold, where it says that I am going to purchase something on a long term basis, I am holding it for a particular period of time, and I will retain this particular investment if suppose it is at par with the market return, and I am not much concerned about the market fluctuations in the short run. So, this is how the passive investing works. So, what are the different types of passive investments you have? You have something called an index fund. So, index fund, normally it is considered to be the most safest fund in which you can invest, and it can give you a positive return in the long run. So, you have mutual funds which has created the index fund for particular market, different markets. So, I have index fund which is related with Sensex. There could be certain index fund which is related with Nifty. So, similarly, certain mutual funds might have created funds which is moving in line with the overall market. So, that is called index fund. And here what they are trying to do, they are trying to pull the investors who have similar intention to purchase such stocks in index, and which is not having much exposure to the short run problems which is having, and overall whatever I am going to get in terms of return would be equivalent to the market return, which talks about the diversified basket of securities. Okay. So, the gain is higher in comparison to the market return which it has. The second type of investment what you have is exchange traded fund. So, exchange traded fund is nothing but they track the market index, but trade on exchange like individual stocks, right. So, they are tracking the individual market index, and they trade on this by considering this as a particular stock. So, I am going to make this a separate fund sort of thing. Okay. So, I identify and put different stocks within my portfolio which is in line with the market index, and but I am considering this particular this portfolio as one stock. So, that type of stock is called the exchange traded funds. So, here this will allow the investors to either buy or sell share throughout the trading day, providing flexibility, liquidity, and maintaining low cost. So, the reason why exchange traded fund is beneficial could be for the reason that these funds in itself is acting as individual share, and this has incorporated those securities which is trying to move along with the market index, and it can be either purchased at any point of time in a trading day, and since it is a basket of securities put together, it is going to help me in reducing the overall cost. Otherwise, I would have spent money in purchasing this particular security separately, this particular security separately, and if there is any more in my diversified portfolio separately. So, now what I am trying to do is I am trying to take this whole thing as a unit which is called the ETF, and I can either buy and sell. So, buying and selling an ETF, it is equivalent to buying and selling say n number of securities which is part of it. So, that is the advantage you can get. So, advantage low fees, it means to say it is having a lesser expense ratio in comparison to the active fund, and you are going to spend less on research because very long period analysis is being done. I am not bothered about short term gains which I am going to do. It is going to reduce the transaction cost, as I told you. So, transaction cost is reduced because I am very passive. If suppose it is my stocks or portfolio is going to give me a return which is almost equivalent to the market return, I'm happy about it. I'm not going to excessively trade. So if I'm not going to trade, I'm going to save on the transaction cost. The third important advantage is simplicity and transparency. It is very simple. My simple logic is it should be a mirror of the index. Okay, and if suppose it is giving me this, the investor is very clear that he is investing in the right portfolio or right stock, and there is transparency in my investment decision also, or investment option also, where I say that this is my requirement, and based on my requirement I am trying to put my money for a longer period of time with the amount of risk whatever I am going to take. What are the ideal cases for passive investing? The ideal cases is long-term investment, as I told you, cost-conscious investors, where I am going to pay lesser transaction cost and the fees which is involved over there, and the diversification needs becomes very less. So if it is funds, diversification is already done within the funds, and I am purchasing those funds on a longer duration. So these are the ideal cases in passive investing. Here I am talking about advantages of active investing. It is going to give you a higher return, because outright throughout the day I am going to look how an individual stock is performing in comparison to the market indices, and then trying to diversify based upon the requirement of making profit, right? So there is a potential for high investment. Second is there is flexibility, where I do not link it with overall market. I am just concerned about getting maximum out of a minimum investment. So I am not concerned about the market changes or economic trends and other things, because automatically when I am constantly watching at the prices and other things, these market change and economic trend is adapted by the market in itself. And the third one is portfolio customization. As the name suggests, the managers identify those stocks which fit into my portfolio with specific goal of making maximum profit with a particular level of risk. And the advantages of passive investing, as I told you, low cost, I think this is a repetition. Yeah. Disadvantages of each strategy. The disadvantage of active investing is all these high cost, increased risk of underperformance and market timing difficulty. All these things are there because it's a constantly changing market. So there are many things. So transaction cost would be higher. The frequency of changing the stocks would be higher. The amount of risk which you're going to take would be higher. All these things are there. So, and the disadvantages of passive investment is that you sometimes there is no flexibility, and if suppose there is a downfall in a particular stock for a short period of time, probably you are not able to look into it and make your fund grow, right? So that's another important thing which you should think about, because money is all about how you can convert your money into a wealth aspect, right? So wealth maximization is not possible in passive investment, whereas active investment talks about taking risk, but getting higher return, but the risk factor is very high over there. So in this particular lecture, I have discussed about what is meant by active and passive investing, and how it can be used by investors based upon the risk perception and the amount time duration for which the investment has to be done. And this can be clubbed together with the earlier matrices, performance evaluation matrices, which we have already seen in the portfolio evaluation lectures, because there when you are talking about any of the different matrices like Jensen alpha, or where I am trying to measure the manager's performance, I should understand whether the particular manager is looking at from a active or a passive strategy, right, and fund for whom it is meant. Only then the measurement becomes right. So based upon, so those are portfolio evaluation matrices, and that portfolio evaluation matrices will have an impact on whether you are an active or a passive investor. Okay, and based on that you can find out how the returns you can get. Thank you.